BlackRock. The name itself evokes a sense of solidity, of permanence, of power, and for good reason. This financial giant, with its tentacles reaching into nearly every corner of the global economy, manages more money than any other institution on the planet. Imagine a sum so vast that it dwarfs the GDP of most countries. That's BlackRock's domain. But how did this financial colossus come to be? What forces, what innovations, what personalities propelled BlackRock to its current position? The story begins, as so many do, with a single individual, Lawrence Fink, the company's founder, chairman, and CEO. His journey, from modest beginnings to the pinnacle of global finance, is inextricably intertwined with the rise of BlackRock itself. What started as a small startup in 1988, nestled within the bustling office of a much larger firm, has blossomed into a behemoth. BlackRock today manages trillions of dollars in assets, impacting the lives of millions worldwide. This is the story of that remarkable ascent. Lawrence Fink's story is not one of silver spoons. Born in 1952 and raised in a middle-class Jewish family in Los Angeles, Fink's upbringing was ordinary. His father owned a shoe store, his mother was an English professor. Fink had a natural affinity for mathematics. He pursued political science at UCLA, but finance became his true calling. He immersed himself in bonds. After graduating in 1974, Fink moved to Wall Street. He joined First Boston, rising quickly. Fink's innovative thinking set the stage for his success. Wall Street in the 1980s was a whirlwind of ambition and risk-taking. Lawrence Fink thrived, quickly establishing himself at First Boston. His specialty was mortgage-backed securities, pivotal in his success and the global financial crisis. A miscalculation led to substantial losses and a humbling experience. This setback proved to be a turning point. Fink envisioned a new kind of financial firm. In 1988, he co-founded BlackRock. From its inception, BlackRock distinguished itself from its competitors through a relentless focus on two key principles: sophisticated risk management and technological innovation. Lawrence Fink understood that in the ever-shifting sands of global finance, understanding and mitigating risk was paramount to success. This philosophy was embodied in Aladdin, BlackRock's proprietary risk management platform. Aladdin, short for Asset, Liability, Debt and Derivative Investment Network, was revolutionary for its time. It provided BlackRock with a comprehensive, real-time view of its vast and complex portfolio, allowing the firm to make more informed investment decisions and manage risk more effectively. Beyond its technological prowess, BlackRock also adopted a unique approach to asset management. Unlike traditional firms that focused on picking individual stocks or bonds, BlackRock took a more holistic view. They constructed diversified portfolios that encompassed a wide range of asset classes, from equities and fixed income to real estate and alternative investments. This approach, known as asset allocation, aimed to maximize returns while minimizing risk across market cycles. Section 5. Aladdin, the rise of a risk management powerhouse. BlackRock's rise is linked to Aladdin's evolution. Initially for internal use, Aladdin gained industry recognition for real-time risk views. BlackRock began offering Aladdin to other financial institutions. This move was a stroke of genius. Banks and asset managers leveraged Aladdin's analytics. Aladdin's client base grew rapidly. It improved risk management and financial stability. Today, Aladdin is the gold standard in risk management, a testament to BlackRock's innovative spirit. Section 6. Weathering the storm: BlackRock's resilience in the 2008 crisis. The 2008 financial crisis shook the global economy to its core. Lehman Brothers, once a titan of Wall Street, crumbled into bankruptcy. Bear Stearns, another venerable institution, barely escaped a similar fate through a fire sale to JP Morgan Chase. The financial system teetered on the brink of collapse. Amid this turmoil, BlackRock stood apart. While other financial institutions were reeling from massive losses and forced into government bailouts, BlackRock weathered the storm remarkably well. How did they do it? The answer, in large part, lies in their unwavering commitment to risk management and the power of Aladdin. Aladdin's real-time risk analytics provided BlackRock with a clear-eyed view of the unfolding crisis. They were able to quickly identify and mitigate their exposure to toxic mortgage-backed securities, the very assets that brought down so many of their competitors. This foresight, coupled with their diversified portfolio and strong balance sheet, enabled BlackRock to not only survive the crisis, but to emerge from it even stronger. Section 7. Strategic acquisitions, cementing market dominance. The 2008 financial crisis presented both challenges and opportunities. As the financial landscape underwent a seismic shift, BlackRock saw an opportunity to solidify its position as a global leader in asset management. They embarked on a series of strategic acquisitions, capitalizing on the struggles of weakened competitors. One of their most significant acquisitions was the purchase of Barclays Global Investors in 2009. Barclays Global Investors, a pioneer in the field of passive investing, managed trillions of dollars in index funds and exchange-traded funds. This acquisition propelled BlackRock to the forefront of the rapidly growing ETF market, further diversifying their offerings and expanding their reach into the retail investment market. These strategic acquisitions, coupled with their continued organic growth, cemented BlackRock's position as the world's largest asset manager. They had successfully navigated one of the most turbulent periods in financial history and emerged as a dominant force in the industry. Section 8. A sustainable future. BlackRock's new frontier. In recent years, BlackRock has increasingly turned its attention to the issue of sustainability. Under Lawrence Fink's leadership, the firm has become a vocal advocate for incorporating environmental, social, and governance, or ESG, factors into investment decisions. Fink's annual letter to CEOs, widely read in the business world, has become a platform for him to urge companies to adopt sustainable practices and address climate change. BlackRock has backed up these pronouncements with concrete actions, launching a suite of sustainable investment products and actively engaging with companies to promote sustainable business practices. This focus on sustainability has not been without its critics. Some argue that BlackRock, as a major investor in fossil fuel companies, is not doing enough to combat climate change. Others question whether ESG investing is truly effective in driving positive change or simply a marketing ploy. Despite these criticisms, BlackRock remains committed to its sustainability agenda, arguing that investing for the long term requires considering ESG factors. Section 9. The power and influence of BlackRock. A double-edged sword? The sheer scale of BlackRock's assets under management gives them unparalleled influence in the financial markets. They are major shareholders in countless companies across all sectors of the economy, giving them a powerful voice in corporate boardrooms. This influence extends beyond the corporate world. Governments and central banks often seek BlackRock's advice on economic and financial matters. This level of power and influence, however, has not gone unnoticed or uncriticized. Some argue that BlackRock has become too big, too powerful, posing a systemic risk to the financial system. Others worry about the potential for conflicts of interest, given their involvement in so many different aspects of the financial markets. BlackRock, for its part, maintains that it acts in the best interests of its clients and that its size and influence are a reflection of its success in meeting their needs. They argue that their focus on long-term value creation and responsible investing benefits not only their clients, but also the broader economy. Section 10. BlackRock's critics, concerns, and counterarguments. BlackRock's critics often point to the potential for conflicts of interest arising from their vast holdings and influence. For example, BlackRock manages trillions of dollars in passive index funds, which track specific market indices. This means they own shares in virtually every publicly traded company, including competitors within the same industry. Critics argue that this could potentially lead to situations where BlackRock prioritizes its own financial interests over those of its clients or the broader market. They also raise concerns about BlackRock's growing influence in Washington, D.C., and its close ties to policymakers, suggesting that this proximity to power could lead to regulatory capture or other forms of undue influence. BlackRock, in response to these criticisms, emphasizes its robust internal controls and ethical guidelines. They argue that their fiduciary duty to their clients is paramount and that they have a proven track record of acting in their best interests. They also point to their transparency initiatives and engagement with stakeholders as evidence of their commitment to responsible corporate governance. Section 11. The future of finance. BlackRock's continued evolution. As the financial world evolves, BlackRock is at a crossroads. Globalization, technological innovation, and market complexity create new challenges. How will BlackRock navigate these and shape finance's future? Will they grow their asset base or face pressure about their size? Can they manage climate risks or face criticism? Time will tell how BlackRock's story unfolds.